much.
Very good. Well, thank you for inviting me to be part of this. My name is Andrew Wingender. I'm your dedicated internal wholesaler with Ameritas Insurance. We're going to be focused on the annuities today. So I'm just going to make a brief disclosure. I am going to be focused mostly on the annuities that we have available nationally, which is to say outside of the state of New York. If anybody's located in the state of New York, we definitely can cover what we have available. But the things that I will be discussing primarily are for 49 states and the District of Columbia, and not for New York State. So just giving that disclaimer ahead of time, I want to make sure that I am giving you that as a little preparation. I'm going to go ahead and share my screen. Let's make sure everybody can see. I am logged in right now to the Ameritas Producer Workbench. If you haven't had the opportunity to sign up, make sure that you do that. You are looking at my screen now as the new workbench. So you'll see here that this has a few tiles for my quick links. This is a very good system. I strongly encourage everybody to get to it. But if you are just getting familiar with Ameritas, it is not the most intuitive system. So you may not necessarily know which quick links you need. And since you don't know that, you won't have them preloaded for you. It is a little bit easier to navigate through our classic dashboard. I'm going to click the link here, which will show you. You'll see this red banner across the top. That's how you see that it is a classic dashboard as opposed to the new dashboard. Again, the new dashboard, more functionality, easier to navigate once you know what you're doing. But if you don't even know what you don't know, this is the better way to go and to get yourself familiar with what Ameritas has to offer. I'll just show you here in the day-to-day task section, which should cover most things that you'll want to learn about. Up at the very top is prepare for a sale. This will link you to all of our product information. I will show you here as well. If you click on the selling a new business, prepare for a sale is there as well. And once you come here, you will see all of the different products that we have to offer, as well as some other information. I will make sure to point this out. Actually, let me take you to our fixed annuities, which is where I'll go here. And you can see the different options that we have. Now, as disclosed before, we do have several annuities that are only available in New York. We have other annuities that are available not in New York, but in the other 49 states. And those are the ones that I'm going to be focused on now. So this Compass Flexible Life, we're just going to leave on the back burner for now. I will point out that the Compass Single Premium Immediate Annuity, the SPIA, that one is available. So we will touch on that just in a little bit. But I did want to bring your attention to our two core products, the Accumulation 7 Index Annuity and the Income 10 Index Annuity. Biggest difference between these two, the Income 10 has living benefits, guaranteed withdrawal benefits for life, that are available here, a couple different options that you can look at. The Accumulation 7 is really a tool just for growing your clients' accounts. So if you're interested in setting up a contract for somebody who is looking at taking income, either in the near future or after, say, 10 years, this is the option that we would talk about, our Income 10. If you've got someone who simply wants to grow their account, doesn't want the market volatility that we might be seeing, and wants a guarantee that they're not going to lose any money, then the Accumulation 7 is the option that we would typically talk to you with. I'll show you here that if you click on the hyperlinks below, you'll get product-specific information for each of them. And so you can see here a very brief overview of this particular product, the accumulation focus, competitive rate banding, the different choices between the crediting methods that you can go between, an index that is unique here. You'll see the sector rotator. And then, of course, it was called the Accumulation 7. There's a reason for that. It's because it has a 7-year surrender charge period. There is an optional 5-year surrender charge that you can do. So if you've got somebody on a compressed time frame, maybe a 60-year-old who's going to be taking money out at age 65 and they want more liquidity, you can set this up with the 5-year surrender charge schedule. It will cost a little bit. You won't earn as much interest as you normally would, but by choosing that option, they are going to have more access to their cash faster. And then I will also mention that there is an enhanced death benefit rider that is included along with this. So, of course, if this is just a legacy play, there is the ability to use this to help out with that aspect of it. Just to come up here, you'll notice that on the right-hand side, we've got both the client-approved materials and then producer-specific materials that you can look at. So if you are interested in learning a bit more, this producer product guide is going to be the option that you use to get all of the nuts and bolts of this particular product. See, it just skipped me down a couple pages, but I'll show you up here from the start. You've got all the information that you could want if you're interested in knowing, hey, what are the vans? What are the different index options? What do those surrender charges that I mentioned before look like? Here, everything is for you. And I will, since I see this, mention that this is a market value adjustment annuity, MVA. Basically, that means that if interest rates fluctuate, the actual value on a surrender could be adjusted. So if you're familiar with the old story about how bonds are inverse to how interest rates look, when interest rates have gone down, your higher interest rates, your older interest rates, are more valuable. So the price goes up. When interest rates go up, your older, lower rate bonds are less valuable, hence the price goes down. So that's how a market value adjustment might work. If interest rates are going down, you will get a positive adjustment. If interest rates have gone up, you would have a negative adjustment. So that's kind of getting into the weeds of this product. And of course, if you are looking at this, it's always advantageous to call in, say my client is looking at taking a withdrawal. Will there be any surrender charges or market value adjustments based off of their contract? And we can tell you that at the time, but just know that that is something that is built into this product. I'll also say, because of course, if the client does need their cash, there is the ability to have that surrender charge waived due to either a confinement, terminal illness, or home health care. You'll notice that it mentions all of these are no-cost riders, so they are all built in to the product. And then, as mentioned before, there are surrender charges and MVAs, but the client always has a 10% of the accumulation value that they can pull out after the first policy year. So you'll see quite a bit of information in here. What I do want to point out to you is that if you are working with somebody who has a employer-sponsored program, this particular product is the one we would typically use for that. And there's a few reasons, but number one, it is designed for people of all ages. I'd show you this before. So ages 0 to 85. So if you've got somebody who's just starting, somebody who is not looking to get exposed to the market risk, wants to keep their account growing, wants to have security there, this is a good option to use in those situations. So as you're looking here for the different markets that you can choose between, if you had a 401k, of course, that is available with this particular product. I'm not necessarily going to dwell on everything here, but you will see the different riders that you can add, some additional information. Of course, everything's kind of been discussed. If you do want to do the calculation for a market value adjustment, this is what it would look like. Candidly, I don't know the math that well, so I would rather call in and have someone else calculate it for me. And that's why I was making that suggestion earlier. And then I'll just come down here a little bit because I do want to show you, let's see here, the index options that we talk about whether it's the S&P 500, Russell 2000, the MSCI EFA, or the S&P 500 Sector Rotator. So these are the indexes that we use, different calculations. So a 1 year point to point, a 1 year monthly average, 1 year monthly sum, of course, available with the different indexes. You can choose between all of those, and they will have different rates that are set at any given time. Just Xing out of here so we can go back. Okay, you can always see what our current rates are. This is linked here in the index rate cap rates. So this will bring up the current rates on this particular product, and I think the other product is included on that. Yeah, so you see the Ameritas Accumulation 7. You'll note what's going on. We recently had an upward shift. But of course, if you've got the minimum band, that's 0 to 24,999, you get a lesser rate than you do if you have a higher band going up to 200,000 plus. So these are what would be available. And then here, of course, the income 10, you'll see this listed here as well. Let me come here and show you the client brochure. And then I'll want to point out one other thing before we move on to the income 10, but you'll see here, this is the piece that we have available for clients to have. You can download this or you can order a physical copy. So whatever you're looking to do with your client, most of the time we do things digitally now. So just having a saved PDF copy is good enough. But this explains everything to the client in a approved format. I think it's not worth glossing over that Ameritas is a mutual life insurance company. So we are literally owned by our policyholders. And I think that gives us a good feel for what we can provide our clients to make sure that we are able to offer something competitive, something that is good for our clients, and something that is going to be advantageous for you as an agent to have in your back pocket. So win, win, win. I did see a question from Alonzo. Wanted to let you know that the two products I'm speaking about right now, the Accumulation 7 and the Income 10, are not available in New York. There is a different product, the Compass Flexible Premium Deferred Annuity, FPDA. That Compass is available in New York. So I was focusing on these two at the current time because there are 49 states that are covered by it. And I know that Charles has people everywhere. So that's why I wanted to address that. I did want you to know that you are required to complete a training before selling any annuity product. Our trainings occur on the Reg Ed platform. So the link is right here. I won't take you through it, but yeah, see, it's not letting me do it because I'm not an agent. But if you're clicking on that link, it'll take you in and you'll have the ability to complete that particular training. You will have to have that done before you can actively sell this particular product. Just coming back here to the Income 10. And the same story here, of course, on the growth of the client's contract. It's going to be protected from the downside risk. It's going to have the different indices you can choose from. But a major difference, of course, this is called income because the client's going to want to take money out of this. So we have different guaranteed lifetime withdrawal benefits. You'll see that are listed out here. There's several different variations on them. So the two different products that we have are the Protector and the Builder. The Protector and the Builder both have single and joint life options available, and they both have plus options. So I'm going to point out this part here. The plus version of the rider provides 2 times the lifetime withdrawal benefit amount when a covered person is unable to perform 2 of the 6 activities of daily living. So very short story, if you've got a client and they're receiving $10,000 a year of income, guaranteed, that $10,000 is guaranteed for life. But if they have chosen the plus option. And either a single life or one of the two in the joint life situation now has 2 of 6 activities of daily living that are impacted. They would have the ability to access twice that amount. So in this particular scenario, $10,000 becomes $20,000. Just as a disclaimer, that amount is not guaranteed for life. That doubled amount is guaranteed until the contract, say, goes to zero contract value. Once the contract value hits zero, the double effect goes away, but the baseline level of income does remain. So you've got a client who's receiving $10,000. It's husband and wife. The wife has a long-term care situation where they're in a nursing home. They can't perform the 2 of the 6 activities of daily living, and they're taking out twice of the amount, so now $20,000 a year. Eventually, the spouse passes away. Well, at that point, is there any contract value left? Because if there is, of course, it will return to the husband. And if he were to go into a nursing home, the double could come into effect again. But if the contract value has gone to zero, let's just say it's a longer term home health, or not home health, but nursing home confinement. Well, in this particular situation, if the contract value goes to zero, you do reduce from the $20,000 doubled amount back to the original $10,000. But again, that $10,000 is guaranteed for life. So for a single life, guaranteed to pay out for their life, or joint life, guaranteed to pay out for the longer living of the two. Same story before. If you're looking for some more information, the Producer Product Guide right here, great tool for you to use. Get a little bit more information for yourself. In order to explain it to the client, we would use the client guide. Before I switch over there, I do want to just point out this one has the issue age limitation of 45 to 85. So again, a 25-year-old looking to put money aside, this may not be a good option for them. So that's why that's limited to 45. You'll see the same banding numbers here, index options listed down here again. And then here's a brief explanation of the withdrawal benefits. You see the different charges that we're talking about here. I'll just tell you, this is entirely personal opinion. You've got the single life cost, and then you've got the joint spousal cost being the same. I mean, if you're dealing with a married couple, you typically would do the joint life option. Again, there is a plus option, a double, that does increase the cost by 10 basis points. That is a very cost-effective feature that can deliver real value to your clients at a time when they need it. So I really do like these benefits. I think they are very competitively priced, and they deliver a lot of value to the client for what they're paying for them. So it is a good option to consider. Let's just scroll on down, because I will give you a little bit more information on those two benefits. And I'll keep scrolling until you can see. Again, everything I just mentioned, the 1% or 1.1% is laid out here. And then, of course, how do these work? Well, the income protector has a roll-up rate of 7%. So let's just say the client has put in $100,000. Their benefit base would grow to $107,000. And then 114 and some change, and 121. So it is a compounding benefit. So that's nice. And then over the course of 10 years, it would be very close to twice the amount. That would grow the benefit base, which determines how much they are eligible to draw out. But the actual payment is then figured out by the payout percentage. So that percentage determines how much of the benefit base they are going to receive in income. I know this is a little bit complex. I'm going to try to get in and show you an illustration. I think that would be a better way to understand. but I just wanted you to know that this one works for people who are looking to defer for multiple years, grow that income base up, and then do the distributions. The income builder is a little bit different in how it works. So there's this accumulation rate that comes in here, which is 3% plus 200% of the interest earned. Now, the question is 3% plus 200% of interest earned better than a 7% set rate? We don't know, of course. If the client is earning 4%, 200% of that is going to be 8, so plus 3 is 11%. But there are going to be some years where they're not going to earn anything. So, of course, 3% plus 2 times 0 is just the same 3%. So, all in all, the income builder can be a better option for the client. And you'll notice here that it does say that payments start lower than those of the income protector, but will increase with the credits. And so there's a lot of good things that come with both of them. And you'll have to work with your clients to determine a few things based off of, let's just say, their time frame, how many years they plan to defer, what they're looking to generate in income. These are all the ways that you would work with a client to determine what would be in their best interest. Now I'll show you here. Yeah, that's basically, you can go through that on your own, but I will show you here. Of course, there is a client guide for this particular one. And of course, it takes me to the last page. But you'll see here our Income 10 annuity. Notice the nice family and the beach. And of course, this kind of goes through a generic scenario that you can explain to your clients. Right? Before we move along, I do want you to know, again, there is a different training that you have to complete in order to do this. So pay attention to Reg Ed. Again, it won't let me come in here, but I wanted to show you. Just click on that. It'll take you in. Use the product code Ameritas10, and you'll be able to complete your training. Okay. I'm going to go ahead and come back. Just because we did have a question on it, I'll show you this again. The Compass Flexible Premium for Deferred Annuity, FPDA, is the product that we have available in New York. This is more of a traditional fixed annuity. So it is an annual reset, which means that your client will get their first year rate, and then they'll get a second, third, fourth, and fifth year. And this particular product, again, I believe it's got the 8-year surrender schedule. There it is. But yes, if you've got clients looking for something in New York that has guarantees built into it, they can't lose money. This, of course, is there, though no living benefits that are available on that particular one. So we'll just highlight that for you. And of course, let's see here. Where was I at? Oh, well. If I ever get lost, I can always get back to where I'm going just by clicking on the selling a new business and then prepare for a sale. And of course, come back to our fixed annuities. So there we go. Again, I was kind of skipping over this, but be sure you know that if you are doing business in New York State, you complete the Reg 187 requirements that are there. I'm sure you've probably completed them if you're doing any business in New York. But to do Ameritas business, you do have to complete Ameritas specific training. So see again, Ameritas annuity training for New York State. And I'll just point out one thing. Again, I know this will probably not be applicable to anybody who lives out in New York. And if you have clients outside of New York, even if you're in the city, then of course that's a different story. Thank you, Charles. And I wanted to make sure that I was covering this. Yes. I wanted to make sure that you did see that if you do the life insurance course, it does not satisfy the requirement to write annuity products. So some of you may have written a life insurance policy before and have completed this particular training, the 484 NYL. You would have to make sure that you have completed the training for New York, the annuity training. So make sure that you have them both. Okay. And let's just see here. I want to just to make sure all of the bases are covered in that situation. As I did mention earlier, there is a single premium immediate annuity as well. So the SPIA is available for clients in all 50 states and the District of Columbia, multiple different payout options. But one thing that we do a lot of is we use the SPIA as a tool to fund a life insurance contract. So if you're looking at somebody, they have a lump sum, you're looking at a way to do the equivalent of what's called a pension max. You can set up a life annuity to pay out the premiums for a life insurance contract. And sometimes that's a more effective way of creating a life insurance policy than by just doing a dump in. That could create some issues. So I wanted to make sure that you knew these are available. In addition to that, just people who are looking for guaranteed income, if they want it for a joint life, they want to have guarantees built in like a cash refund. All of these options are laid out here. Okay. Now, you've heard me talk for a bit. And of course, anybody with a question, please do ask it. I'd rather talk about what you want to hear than what I want to talk about. But it's a little bit hard to explain this from this standpoint. Oh, by the way, I kind of went over the Apex Advantage. So I will let you know that this is also something that we have available. In my personal opinion, and this is just my personal opinion, I actually like the Income 10 better. This Apex Advantage is designed very specifically for income within 3 years at a maximum. So it does have crediting that is available. That will go for the first 3 years. It doesn't go into the fourth year. So if you've got a client with a shorter time frame, this might be a good solution to consider. But in my personal opinion, the extra flexibility that you get with the Income 10, and candidly, having run several illustrations, I do find the Income 10 to be more competitive in most situations. I haven't run every scenario yet, but I've never come across a situation where I said, well, absolutely, the Apex is the better way to go. So that's why I haven't talked about it as much. But I do want you to know we do have this particular option here. It has one unique feature, which is a large upfront increase to your benefit base. I believe that right now is set at 28%. So $100,000 goes in, and the benefit base increases to $128,000 right away. And so let's see here. Oh, we had a question on the current interest rates, and I want to make sure that I'm showing you this. Let's see here. Index rates and caps are listed. We have this. I had pointed this out earlier, but you'll see here's what the rates were effective December 1st. Sorry, the system's loading and it's jumping around on me. And you'll notice the Apex Advantage rates listed here as well. So you see that 28% upfront rate, and then a 5% roll up through the first 3 years. Just making sure everybody knows. I think there was a question on guaranteed interest rate. I don't know if that means the fixed account, but we do have a fixed account rate here you can see. So you do not necessarily have to be in an index to earn some interest on the account. And of course, you can mix that in and out. There's the fixed account on the Apex Advantage. Okay. And then there was a question about executive bonus. I do think that that's a good tool, but you want to make sure this is something for people who are looking at taking income in the near future. So if you've got somebody who's just building their account, it may not be the most effective tool, but if you've got somebody who's getting near the end of their working life, maybe a business owner, and they're looking to set something up, then obviously, of course, that's an option that you can choose. See here, we do have a question about RMDs, and all of our products are going to be RMD. Let me just make sure that I'm showing you here. I want to use the actual terminology as often as I can. Let me just show you here. Oh, does it not even say this? We've got a required. Yeah, it doesn't address this in here. The products are RMD compliant, so if you do have to take out more, then you can do that. So that is part of the equation. Let me actually, if you don't mind, just jump around a little bit. And there was a question on the compass. Let's make sure that we do that. So where did it come in? Where did I go? All right. Actually, I don't want this. Here. Here is our rate line. I believe it will all be included in here. So I'll show you what the current rates are on the compass. And just the 412E, that would be an accumulation 7 in most cases. Of course, for New York State, where that's not applicable, then the compass would be here. But where am I looking for? Here, indeed. Well, see, this is what happens when you don't know the answer to a question. It took me to rate line, and that's not in here. Yeah, well, I'll tell you what I can do and can definitely show you this. This is where I wanted to go to next. And by the way, thank you. Everybody has great questions. But let's get the rubber on the road, if you will. Now we've got a client and we want to talk about it, and maybe your internal wholesaler didn't know the answer to some of these questions. Well, the good thing is we have an illustration system here, and you would use your life designs to do that. It's the same program that you use to run life insurance quotes. We do for these annuities. The computer knows everything. So I'll just create a new generic client. I'm gonna make this person a New York client because I know this is going to answer that question. So let's just make it a 55-year-old. And we're going to make a new illustration. I always click on basic, but you can do illustration here, and it'll bring you into our template. So if you wanted to, all plan types, look at our Compass Premium Flexible Annuity. This current interest rate at 2.95%. See here, this has got to be, of course, $5,000 going in annually. Just say it's, oh, no, that's the recurring amount. Let's say you wanted to do a lump sum of 50,000. You'll notice the interest rate goes up because it's in a different band. Let's make it 500,000. Okay. Oh, no change to the band there. I will just show you here when we look at the final end product. All right. Let this load up. It'll lay this out. So we've got everything that we had mentioned here, the surrender charge schedule, all of the disclosures, and then, of course, the current interest rates listed out here. It's got the life annuity option on it. Yeah, so the rates are always going to be listed out when you run the illustration. I know that you can find the interest rate somewhere else. I'm just not smart enough to find it right away, so my apologies here. Let's see here if I can find. If I do a quick rate line, let's see, annuity rate line. All right, when in doubt, use the search bar. So, let's see, did I go too far? Let's see here. Let's even that. Oh, now it's too small. Okay, so here you are with the two different bands, Compass Flexible Premium Deferred Annuity. Band 1 is 2.95. Band 2 is 3.35. So as we saw, whether you're putting in that, let's see, where does it say the band here? See, under 10,000 is one band, and then band 2 over 50. I should be able to read this quicker. But yes, once we get into the higher band, we now have the ability to get that higher rate. So yeah, the Compass. Here we go. Band 1 is under 50,000. Band 2 is 50,000 or more. There we go. That particular line is what we needed. Okay. So I knew I would find it eventually. But I do want to make sure. Here's what we need to do. In fact, I'm just going to come back and put a new client in any state. So again, all other states besides New York have the accumulation 7 and the income 10. It's just preset to Nebraska because that happens to be where I'm located right now. And if we're going to do a new annuity illustration, we'll just start here with, our accumulation 7. So I'll show you here this 25,000 amount. That's a presumption that the client's going to be making recurring contributions. So year after year, they're putting in that 25,000. For simplicity's sake, let's just deal with a very round number as a lump sum. That's easier for my mind to wrap around things and see how they work. And of course, if you're interested in using this 5-year surrender charge, we simply click that off. Okay. Now, something that was mentioned before, there is these enhanced death benefits. You get the basic, but if you're choosing the accelerated schedule, you cannot choose the plus option. So I've selected plus. I cannot select the 5-year. If I select the 5-year, it doesn't give me an option for the plus. So just so you know that, of course, qualified and non-qualified, we don't break it down per product type, but whether it's a qualified or non-qualified, you'd have to provide the cost basis for us. And then it does ask for the different type that we're working with here. So I'll keep it at that. If you are looking to schedule some cash flow, let's see here. Oh, indeed, it doesn't say comply to RMD because I didn't have it set to that. But let's just say it's a traditional IRA and you want to make sure that it's RMD compliant. We check off this box. I'm not going to schedule anything here because I just do want you to see. We're going to preview. And so here the client's got their annuity contract. In fact, I think I made one mistake. And I'll show you what my mistake was. In the policy information, it does hide the allocation. So you actually have to click on this box. And it presets you to the fixed account. Now, I get more value out of seeing an index and how it works. So I'll just click on that. And here we'll see, obviously the S&P 500 point to point means when the S&P goes up, you're going to participate in that up to a cap. When it goes down, you're not going to lose anything. You are protected from loss. However, there is actually, in this case, a fee that is being paid because of that 5-year surrender charge we did. So yes, technically in a negative market year, the client's account balance could go down because they're paying for that extra liquidity. So just wanted you to know that. And I'll show you here, we've got our current cap of 8.55, 100% participation rate. You'll notice that some of these are higher. Okay. So there is the ability to earn more than that. But you can see here just a hypothetical, what have the last 10 years looked like? What is a low 10-year period look like? What does a high 10-year period look like? So it fluctuates between 5.33 to 6.7 annual rate of return based off of all of these assumptions. Now, the average is there in the middle. You'll see how this is all laid out. So yes, technically, you could have some of these really great years all working out for you. But I'll just show you what that actually means when the rubber hits the road, as I said. Okay. In this particular illustration, the very first year, we did not have any accumulation. So the policy value does not go up. It actually goes down. As you can see, it goes down by $150. Well, that's your 15 basis points. So the extra liquidity cost did cost you $150, but that's just a story for 1 year. In subsequent years, we are earning interest. You can see this laid out here. You can see the surrender schedule. And then I do want you to know, of course, this guaranteed minimum surrender value is if there was a very severe market value adjustment that would take it down. That would not affect this, or if you had multiple 0% years, this is a worst case scenario. But the actual product experience as illustrated is significantly better than that up until when we hit the age of 72, and then that's an end of year age. So the next year you're doing your required minimum distributions, and you'll see that these are calculated to all come out. I just want to, let's see here, mutual. Yeah, it's interesting. To be quite candid, there's a question about the different indexes like the NASDAQ 100 or an S&P 6-month point to point. I almost think that it's kind of the issue that you get when you have too many items on the menu. I mean, who doesn't like going to Five Guys and seeing that they have burgers and fries and a shake, right? That's all I need. So I'm happy with that. But if you're, giving multiple options, I think it does confuse things, and we don't see what everyone has as something of an advantage. Certainly, the NASDAQ is a good option right now because tech stocks have been doing great. There's some concern that they're overvalued because the term AI bubble is out there. The industry is what's called frothy. Okay, well, if that's the case and technology goes down, I'm old enough to have lived through the late 90s. And at that time, of course, being invested in pets.com was a wonderful thing. But in the early 2000s, not so great. So that's, I think, one of the issues that I would, thank you, Alonzo, Y2K all over. I like to make the joke, they keep calling these things, once in a lifetime experiences, whether it's the tech bubble bursting or the, financial crisis of 2008 or a global pandemic in 2020. It's like there's all these once in a lifetime events, and I've lived through 3 of them now. And I know some people have lived through other ones, whether it's 1987 or certainly other things that have happened. Well, that's the only thing that we can rely on, right? is that the world's going to go crazy from time to time, and then it gets its head right, and we get back to normal. So that's what this particular product is designed for. When the market is doing well, you are going to capture parts of that. When the market is not doing well, you are not going to lose based off of it. And you can just see, this was a policy just designed for somebody who was taking their money and going to let it grow, take out their RMDs. Of course, if you wanted to generate a guaranteed stream of income, we could talk about using our Income 10. So let's go ahead and do that. And I want to be conscious of time. Charles, I don't want to run over too much, so you stop me when I need to stop talking. But if you've got somebody trying to get a guaranteed stream of income, I'll just show you here, same assumptions, but now we've got our GLWB.
And Andrew, we're good to 1:15, so got 15 minutes.
Wonderful. I will try to talk quickly and not let my speech impediment get in my way, but showing you here the Protector, Protector Plus, Builder, Builder Plus, or you can do a comparison of the two. I'm just going to jump into that because I want you to see both of them. I'm going to show you that we are going to start taking withdrawals. Let's go ahead and do that in 10 years. And if the RMD is a bigger number, we'll take out the RMD amount. Okay. And of course, the cash flow is actually going to be controlled because of that. So we've already selected this. We don't have to worry about this at all. Oh, let's make sure that it kept our allocation. Again, put me in the fixed. I could show you each and every one of these. We could do, 10% in all of them. I think just to keep things simple, the S&P 500 1-year point-to-point is what I'm going to go with, because almost everybody is going to have some knowledge of, hey, how did the stock market do this year? Was the Dow Jones, the S&P 500 up? You typically have those reported on the nightly news. If they've got a 401k and they're getting quarterly statements because of it, you're going to have some sort of a benchmark that they can rely on, and everybody has a good feel. Now, of course, if somebody starts a contract on December 9th, they might not necessarily have the same 1-year period that, the nightly news is going to tell you that the stock market is up year to date or it's down year to date. Well, the year doesn't matter. It matters what your year is. So the calendar doesn't really determine that. Just so you know, I'm always clicking on preview here. That takes us right into the presentation. If you do click print, sometimes there are additional options here, but it's just an extra thing to click, so I don't typically do it. Let's just see here. All right. This I want to show you. So again, we made our choice. We did the 1-year point-to-point. You see again, different numbers that are listed out here. Obviously, part of that return differential is going to be because we're paying for a living benefit on top of what we're actually getting. So the actual realized return are these numbers, but that affects the contract value. Let's make this just a little bit bigger. So you see the accumulation value here is fluctuating. It's going up. It goes down a little bit in some years because you're paying for the living benefits. But over here in the light blue area is where our benefit base is changing. Now, I just want you to understand how this works because this is a little bit tricky. I had to wrap my head around it. Our illustration is based off of an end of contract year. Basically, this is on day 365. Your benefit base is $100,000 because that's what you put into it. Now, on day 366, it goes up by 7%. So that's why you're only seeing these numbers increase starting in the second year, because this is technically the number at the beginning of the second year. So just wanted to make sure that you understood, hey, Why did we earn nothing in the first year? Well, technically, within the first year, your benefit base doesn't roll up. But you'll notice here, this distribution factor, that's how much of the benefit base you'll get. So in this particular scenario, we let it run for 10 years. We got our distributions beginning at age 65. You'll notice here, this is where all these numbers are coming from. So the 12,152, but it does have the plus option. So at any point, if the clients were unable to do 2 of 6 activities of daily living, the 12,000 would go up to 24,000. Now, once this doesn't show that amount coming out, that extra amount coming out, but of course, taking an extra amount is going to drive your cash value down even more quickly. So you'll hit 0 sooner. Once the contract value is at 0, the amount will revert to 12,152. See, if it doesn't really let me highlight for some reason, but you'll notice here that amount is continuing, guaranteed for life. So even here, this is just the last year it lists is age 105. And if your client's 105 years old, they're still getting their $12,152 out. See, does it sum it out? No, it doesn't. But you can see in that case, they would have gotten 40 years of 12,000. I'm not a math genius, but that's somewhere around 480,000. You know, just shy of $500,000 total over the course of their life. Okay? So that's the power of this particular benefit. I will show you the builder now. So again, this one is being built off of some assumptions. In this particular case, in the first year, we're getting nothing credited. So we're just paying that rider fee. The benefit base will change on day 366, first day of the second year. But in this particular case, it's only gone up by 3% because we had 0. So what's 200% of 0? It's still 0. So you got 3% plus 200% of whatever is credited. That's where that $3,000 number comes in. Now, I'm afraid to say I'm not smart enough at math to figure out what this is, but that's approximately a 10% increase. So you earned maybe 5%, and it got doubled, and you added, well, I guess that wouldn't be the right number, but you earned 4%, it doubled to 8%, and then you add 3% to it, and that's how we go from 103 to 118. Okay. Someone can check my math on that, but that's where this benefit base increase is coming from. Now, obviously, this one is going to be more subject to how the interest is credited and how the market is performed than the protector is. But under this scenario, it actually ran itself out and looks a little bit less. So the builder here is $11,114, or double it up to $22,000. So just a little bit less, but it could be more. It could be less than this number even, but that's how the builder works. Same double on the plus option. And of course, both of them have joint and, yeah, interesting. Oh, yeah. So they both do have joint and single life options. And then one of the unique features of this I didn't mention that I should have. This amount does increase. It still continues to go up even after the distributions have begun. So in years where there is interest credited, that benefit base will continue to increase. So there are benefits to the builder that are worth considering. Okay. Don't really think that anything else in here is applicable, but of course it gives you the definitions and all of the disclosures. So we can go to that. And, you know, I was going to do a SPIA as well, but to be quite candid, this is pretty straightforward. I'll just show you if you put $100,000 in, choose your settlement options. I would never pick a life only unless it was a pension max type of situation, but a period certain like 10 years, an installment refund or a cash refund. Installment continues to pay out progressively until the full basis has been returned. A cash refund will give a lump sum distribution equal to the difference. And I'll just let you see this very quickly because this, of course, is a strategy that you can use. I like SPIAs. I think in an age where we don't have pensions anymore, having guaranteed stream of income are very important. And you'll just look here. Life only obviously is the highest payment. Then when you're getting the guaranteed payments coming out, nothing is certain except for this particular period certain, but you will definitely receive your $100,000 initial investment back through an installment refund or a cash refund, just whether it's paid out over time or as a lump sum. And that's why that's a little bit different in the annuity payments. So running around 500, 480, $475 as a guaranteed stream of income every year. And there's the definition. So I think I'm going to stop talking now because we are right bumping up at the end of time. But that is an overview of all of the annuities that we have to offer here at Ameritas. Of course, make sure that you're doing your annuity training through Reg Ed. And if there's any last questions, I'm happy to field those.
I see that some questions in the chat. I think you covered those. Alonzo had a question. What product will be used for a full 12E3?
And that one would be the accumulation 7. I think I was listed in there, but if you have a question, I should type the whole thing out. If you have a question on one of those circumstances, I know enough to know that I can't answer everything. And so I like to transfer them over to our advanced planning team. Just know if you've got something in the works, you want to get me involved in it, I'm happy to do it. But I'm confident enough in myself to say I don't know. And so that's a situation. In fact, here it is, 412E3. So right here. So if you say I've got a client, they're looking at doing this, and I say, hey, I don't know what I'm talking about, and I don't want to lie to you. Let's get you the right answer. I would typically refer those to advanced planning, and that team is great at helping out. They know a lot more than I know. As I like to say, they've forgotten more than I'll ever know about some of these things. But the Accumulation 7 is the product we typically use for that.
And last question with the Accum 10, can you just quickly go over the benefits? Why would someone roll their old 401k or 403b or old 457 that they had at an old employer? What's the benefits to rolling that into the Accum 10?
Well, let me tell you something. This is personal preference, but this is what I like. Is when I look at this, and it just to clarify, it's the income 10, so not the accumulation 7. They have those different prefixes. But if you're looking with somebody, and in this case, 55-year-old, they were working at one company, have now taken a new job, they've got that old 401k. Let's get that out of there for 2 reasons. Number 1, eliminate that market risk. Number 2, grab the benefits that we're talking about. So I can look at my client and I can say, in this case, Mr. Valued Client, you're going to give me $100,000. I will give you $12,152 for the rest of your life. That's $1,000 a month, guaranteed, that you're going to get. If you do need more because you're in a nursing home or you can't perform these activities of daily living, double that. Guaranteed as long as you've got $1 left in the contract. So that's what I'd like to say is, here's how we set your retirement plan by clockwork, right? We can tell you exactly what you can expect and when you can expect to receive it. That's the power of this, is not having to guess, not having to say, well, if the market goes up by this amount this year, we're going to have that amount that we can, you don't want to have to play the game of, if I do a late retirement and an early death, am I going to be able to get by? The other thing is, and this is just psycho- psychological, people value guaranteed income way more than they do just getting it. How many people are living paycheck to paycheck? A lot of us. And you're looking at something, and if your car breaks down and your kid comes in with a broken arm and you've got all these extra expenses and you say, we're going to have to figure out some way to get by. Well, the beautiful thing is, people who know they have a guaranteed stream of income that they can rely on are actually more likely to live longer because as you get older, finances can be very stressful. Stress is a big killer. So if you do want to have an extended retirement where you live for a long time and you don't have to worry about whether your money is going to run out before your life does, this is going to answer that. So the two things, Charles, that I would say is number one, we're taking the money out of the market. We're not playing the games anymore. We are setting a clock. And then once that timer runs out, in this particular case, I ran it at 10 years, we are beginning those distributions. And there is no timer on that. It goes as long as you do. So that's what I would say to you is as you're talking to your clients, say, I can tell you what you can expect because of these guaranteed lifetime withdrawal benefits.
And that is powerful. Thank you so much, Andrew. This was a very great presentation. I always learn when I'm listening to you. So hopefully we'll start to pick up the production on the annuity. So we have this is a great product. A lot of clients are not, a lot of agents are, and I could tell you a lot of agents in our industry are not talking about this, and it's sitting right there, right? If anyone needs help with any clients or how to get to the training and through Reg BI, feel free to reach out to me and I can help walk you through that so we can start talking about these products. So with that, Andrew, thank you so much and have a good day. And appreciate you.
Be well, everyone.
Thank you. All right.